The policy trap starts with three uncomfortable truths. Robots and software can displace workers faster than traditional economic tools can adapt. Central bankers can fight price spikes with interest rates, but they cannot retrain a laid-off analyst, designer, driver, or support agent. And while consumers face higher costs for groceries, housing, and debt, many traditional career paths are being rewritten by artificial intelligence. That is why the Federal Reserve matters to your wallet, but cannot fully rescue workers displaced by AI. To understand the trap, picture a massive cargo truck descending a steep mountain highway. The truck is the United States economy. The Federal Reserve is the driver. Monetary policy is the instruction manual. The federal funds rate is the brake pedal. CPI, inflation, is the speedometer showing how fast prices are rising. When the speedometer climbs too high, the driver presses the brake. The truck slows. In economic terms, the Fed raises interest rates to cool spending, borrowing, and price growth. That tool can work when the problem is overheating demand. But now imagine something else happens. Huge boulders suddenly fall into the road. The driver can press the brake, but the brake cannot move boulders. Artificial intelligence is one of those boulders. If software eliminates a job category, raising or lowering interest rates does not magically create a new career path for the worker who was displaced. The Fed can slow the truck. It cannot rebuild the road. The Federal Reserve is the independent central bank of the United States. It was created in the early 20th century to help stabilize the financial system, supervise banks, and guide the supply of money and credit. Its most famous responsibility is often described as a dual mandate: support maximum employment and keep prices stable. That sounds broad, but the tools are narrow. The Fed does not run coding boot camps. It does not redesign community colleges. It does not decide which towns get new industries. It does not create a national retraining system for workers replaced by automation. Instead, it manages the general financial temperature of the economy. That is where monetary policy comes in. Monetary policy is the Fed's strategy for influencing money, credit, borrowing costs, and spending. When the economy is weak, policymakers may try to make money easier to borrow so businesses invest and households spend. When prices rise too quickly, policymakers may make money more expensive so spending slows down. Think of it as controlling the pressure in a huge economic pipe. More pressure sends money moving faster. Less pressure slows the flow. This can help during normal recessions or demand-driven inflation. But AI job displacement is not a normal business cycle. It is structural. A call center worker may not lose a job because consumers stopped buying. They may lose it because one AI system can answer thousands of questions at once. A junior copywriter may not be laid off because the economy ran out of money. They may be laid off because software can produce first drafts instantly. A bookkeeper may not be replaced by a recession. They may be replaced by automation built directly into accounting platforms. That kind of disruption requires targeted responses: education, reskilling, mobility support, wage insurance, new business formation, and serious workforce policy. Monetary policy is too blunt for that job. Now look at the main lever: the federal funds rate. The federal funds rate is the interest rate banks charge each other for overnight lending. That sounds remote, almost invisible. But when this rate changes, the effects spread through the economy. Credit card rates can rise. Mortgage rates can become more painful. Auto loans can cost more. Small business loans can become harder to justify. Companies may delay hiring, expansion, or investment. Investors may become more cautious. Households may spend less because debt is more expensive. That is the point. Higher rates are designed to slow demand. If fewer people borrow, fewer people buy. If fewer people buy, businesses have less pricing power. If demand cools enough, inflation may come down. But there is a human cost. When borrowing costs rise, companies often protect cash. They freeze hiring. They cut experimental projects. They reduce training budgets. They demand more productivity from fewer people. For a worker already threatened by AI, this can become a double hit. First, automation pressures the job. Then high interest rates weaken the job market. If that worker tries to start a business, credit may be expensive. If they carry credit card debt, the balance becomes harder to escape. If they need to move for work, housing may be unaffordable. If they want training, the household budget may already be squeezed. This is the policy trap. The Fed can fight inflation by creating economic friction, But AI-displaced workers may experience that friction as another barrier, not a rescue. The outcome, the Fed watches closely, is inflation. One common measure is CPI inflation, the Consumer Price Index, which tracks the average change in prices paid by consumers for a basket of goods and services. Food, housing, transportation, healthcare, clothing, and other essentials all feed into the picture. When CPI inflation rises, your dollars lose purchasing power. The same paycheck buys fewer groceries. The same savings account covers fewer emergencies. The same rent takes a larger share of income. Inflation is not just a statistic. It is the feeling of standing in a grocery aisle and realizing the cart is smaller, but the bill is bigger. The Fed generally wants inflation to be low and stable, but getting there can mean higher borrowing costs and a cooler labor market. That trade-off is difficult even in a normal economy. It becomes more dangerous when technology is also changing who gets hired, what skills matter, and which careers remain viable. So why can't the Fed simply focus on AI unemployment? Because it was not built for that mission. The Fed can influence aggregate demand. It can make credit easier or tighter. It can support financial stability. But it cannot decide that displaced warehouse workers should become healthcare technicians. It cannot force companies to retrain administrative staff instead of replacing them. It cannot guarantee that the next generation of jobs appears in the same cities where old jobs disappear. That responsibility belongs to a wider policy system. Congress, state governments, schools, employers, unions, community colleges, and local institutions. If AI creates structural unemployment, the solution must be structural too. For your personal finances, this chain reaction matters in 4 major areas. First, groceries and necessities. If inflation rises faster than income, households feel poorer even when paychecks do not change. The practical defense is boring but powerful. Track recurring expenses, compare unit prices, switch to lower-cost substitutes where quality does not matter, and build a realistic food budget before the month begins. Second, housing and mortgages. When interest rates are high, monthly payments can jump even if home prices stay flat. Renters may also feel pressure because landlords face higher financing and maintenance costs. The defense is flexibility. Avoid stretching your housing budget to the limit, keep an emergency fund, and be cautious about adjustable debt you cannot handle if conditions change. Third, credit card debt. High rates make revolving balances dangerous. A balance that once felt manageable can become a financial trap when interest compounds. The defense is urgency. Pay down high-interest debt aggressively, avoid adding new balances, and consider refinancing only if the math truly lowers total cost. Fourth, career security. This is the AI-era category most people underestimate. Your job is not just a paycheck. It is an asset exposed to technological risk. The defense is continuous adaptation. Learn the tools affecting your field. Build skills that combine human judgment with AI leverage. Document results. Strengthen your network before you need it. Create optionality through savings, credentials, side income, or portable expertise. The goal is not to panic. The goal is to stop outsourcing your entire future to institutions that were designed for a different kind of problem. The Federal Reserve can steer the truck. It can press the brake. It can respond when the inflation speedometer flashes red. But if AI drops boulders across the highway, the country needs road crews, new routes, and better maps. For individuals, that means 3 priorities. Protect your balance sheet. Reduce high-interest debt, keep cash reserves, and avoid financial commitments that only work in perfect conditions. Protect your income. Treat learning as a recurring bill you pay with time. Study the AI tools in your industry before they become mandatory. Move toward work that requires judgment, trust, taste, physical presence, complex coordination, or deep domain knowledge. Protect your options. Build relationships. Keep your resume current. Understand your benefits, and stay alert to industries where demand is growing. The policy trap is real because the Fed's tools are powerful but incomplete. Interest rates can cool prices, but they cannot personally rebuild a disrupted career. Monetary policy can manage the broad economy, but it cannot guarantee your place in an AI-shaped labor market. So do not wait for the driver to move every boulder. Learn the road, strengthen your vehicle, carry extra fuel, and prepare yourself to change lanes before the traffic stops.